Great. Welcome, everyone. Let's get started. You might have guessed, if you're a late arriver and you didn't hear the instructions, we're just asking people to introduce themselves in the chat, where they're coming from, who their organization is, and we will get started with this. And I'm pretty proud of us. We're only 3 minutes behind. That's pretty unique for us. Just getting better and better every day. What a great start to 2025, I guess. What we're going to do first is the way that today is going to go. We're going to do. I'm going to introduce ourselves, who are the host of this great webinar, and we can have a quick poll question too. That India, if you want to launch now, that'd be great. We're going to have individually, each of our panelists are going to do a little presentation. Presentation on their organization and where their point of view is from predatory lending. But you want to move to the next slide, India. But we're welcoming you to Fair Credit and Fair Chances, Protecting Communities from Predatory Lending, and very excited about our panelists, Dustin, Valerie, and Gabe. And I'll do a little introduction as each of them introduce ourselves. But we also have, we're very happy to provide this opportunity. We've had a lot of individual financial coaches and our business development organizations really talk about how this is an issue that they're facing in their communities, with these exorbitant interest rates for personal loans or auto loans or larger scale loans, or people following into this opportunity into a loan that they are ill prepared to pay off, and then they're trapped as the interest grows and grows. And we wanted to give you multiple perspectives. Coming from our perspective, my name is Julianne Dunn. I'm the Senior Program Officer for Workforce and Financial Prosperity. So I really care about how this affects both our individual coaches through the FOCs and the EFCN, and then our businesses through the business development organizations, and even through our justice work and making sure people have the capacity to grow and care for themselves. So I want to get started very quickly with a quick introduction to the LISC team. Some of you are familiar with some of us, and some of this might be the first time you've seen or heard our names, but of course, I'm Julianne. I will be moderating today, but also India Turner, who will, if you just want to wave, Assistant Program Officer for Workforce and Financial Prosperity, and is also hosting and moderating today. And then Corey Mans, who is on this call, but I will not make him show his face, but he really works a lot with our financial opportunity centers and our employment and financial coaching network. Ephraim Palmero is our brand new program officer in small business and rural. And if you're a BDO and have not heard from him yet, prepare yourself, it's coming. And then, of course, most of you know Emily Avery, who's the Deputy Director of Rural LISC, who came from this world, and we just slowly booted her out. Let's get started. The first question of what type of loan do you think is most often predatory practices? Is there an answer, India? You are muted.
Sorry, everyone. There is an answer. Oh, can you all hear me? Okay.
Mm-hmm.
Looks like we're getting some good responses in. If you're in our panel or in our attendees, I'm trying to get everyone in as panel / attendees. So you're not being promoted to panel. So please accept so you can and participate and engage in these polls if they're not letting you. But yeah, you guys should be able to see.
What is the most common answer people are saying?
Right now, it's payday loans. I don't want to spoil anything. I know we're all on the edge of our seat waiting for the answer, but yes, it is payday loans. That is the most common linked to predatory practices. I have the specific source right here in case anyone is curious. One of the the Consumer Financial Protection Bureau, according to the CFPB. They come with high percentage rates, far higher than other loan types. So buyers frequently cannot repay, and they find themselves trapped in a debt trap. And they also are usually target pretty vulnerable communities. So that's why they're the most often linked to predatory practices, those payday loans.
We also pulled that from the National Consumer Law Center.
Yes.
We also have some references to the Pew Center, but we'll get to that later because we why reference them when you can bring a person? But let's just dive right in. Let's hear from the people that are you're most interested in hearing. Our panelists today, if you're in the Brady Bunch Square, it's probably the top left, but Dustin Fuller, he's our Financial Opportunity Center manager at Habitat for Humanity in Findlay, Hancock County in Ohio. I'll get into a bigger introduction in a second, but we also have Gabriel Kravitz, who's a manager at the Housing Policy Initiative at the Pew Charitable Trusts, which if you are looking for solid and reputable research and you aren't looking at Pew, I feel like you're missing an opportunity. And then we also have Valerie Moffitt, who's a senior program officer for LISC. And for many of you financial opportunity centers, you probably know her intimately in a good or a bad way, depending on how well you behave. But what we're going to do is Dustin's going to start first and talk about his perspective as both as an individual financial coach and working in the nonprofit directly with folks. Dustin has been working in nonprofits for 16 years, from fund development to training, communications and marketing, and of course, executive leadership and human resources. He has launched two of financial opportunity service, two of the three financial opportunity centers currently serving rural communities in Northwest Ohio. An incredible resource for us in the FOC cohort, but very passionate about the clients that he works with and the issues that are facing them in the communities. But with that, Dustin, I will let you get started and share all your insights on this.
All right, fantastic. Good afternoon, everyone. Glad to be a part of this panel and thrilled to jump into a topic that we've seen really impact more and more people over the course of the last couple of years. Let's go to the next slide, India. We can go one more. All right. So to let you in on what the Financial Opportunity Center does, if you're not already familiar, we provide free individualized financial and employment coaching to anyone. We're totally privately funded, so we can help anybody regardless of age, income, background, or how life has happened to them. There are no deadlines. We can work with people as long as it takes. All services are driven by the individual and confidential. So we're not going to live tweet your sessions, or do they call that live Xing now? It just sounds weird. And we're not huge on paperwork. As it turns out, adults don't like paperwork and they don't like to be told what to do. So our goal is to provide tools, information, and resources so they can make the best decision for themselves, and then we support them in that. Next slide, please. All right, so outside of the bread and butter coaching, the nucleus of the FOC, we have a match savings credit builder program. We have a digital connectivity program that connects folks to laptops, tablets, and hotspots for free, as well as a workforce development program to connect high-risk populations with entry-level positions in advanced manufacturing. So all of that work, especially with Unify and Work Advance, were informed directly by emerging needs in our community. And that brings us to micro lending. Next slide, please, India. So according to Lending Tree, Americans owe almost $250 billion in personal loan debt as of Q3 of 24. That's $8 billion more than a year prior. And if you look at that number in 2020, it's $145 billion. So it's gone up by over $100 billion in the last 5 years. As you can see, it spiked in 2021 coming out of the pandemic, or I guess the pandemic kind of was 2021. Your personal loan debt balances spiked. And as of Q3 of last year, 24.2 million Americans have a personal loan. What struck me as interesting as we were doing a lot of this research influenced by the need that we saw Debt consolidation, refinancing credit cards were the top two, but number three, everyday bills. And that can be linked to increases in the consumer price index. We know that things aren't getting cheaper and it's costing more to survive. Next slide, please, India. One of the things that we really jumped into, we found through the Bank of America Institute, where they found that 35% of households that were earning less than $50,000 a year were spending 95% of their income on necessities. So on average, households living paycheck to paycheck are spending 90% more on necessities than those who had higher incomes, even though our paycheck to paycheck households were only earning about 20% less than our other households. Other factors that contributed: geography, family size, and access to more affordable options. Now, if you need money and you don't have it, that lays the foundation for what we saw. I'll give you a great example. We all love technology. Yay. In the old days, you had to, if you wanted a personal loan, you had to go to a CD building, you had to meet with people, you had to review the paperwork, sign on the dotted line. Thanks to technology, we can now access loans from our couch in our moo-moo eating our Cheetos at 2 a.m. What we saw over the last 2 years was folks would get one personal loan, and then they'd get a second one to pay off the first one, which never worked. And unfortunately, they're like Lay's potato chips. Once you get into that cycle, you can't stop at just one. We've seen families with as many as 4 to 5 personal loans from 4 to 5 different lenders. Now, I want you to understand that the data that we're showing you right now, that is what I would consider the more credible sources for personal loans. And we'll dive into some of the sticky situations that arise from these online lenders. Next slide, please, India. All right, this is where it gets fun. So if you look at personal loan stats based on credit score, if you have a great credit score, 17.43% looks great because it's a lot less than your average credit card interest rate. But as you go further and further down, you see if you have a 560 or less, you're paying between 160% and 191% interest on the money that you're borrowing. And you think that sounds outrageous, but there's a whole nother level. There's another layer to this problem. And I'll give you an example. There is one online lender that I've encountered with a few of my clients. I'm not going to name drop because I don't think we can do that. But while some personal lenders will say, hey, we charge 400% interest, others are sneakier. And what they do in this case, if you want a $1,500 personal loan, your monthly payment's only $30. That sounds reasonable. Unless you don't pay back that $1,500 balance in 30 days. Because what they've done is couched fees into repayment. So if you don't pay back that $1,500 within 30 days with this particular lender, they charge you a $174 billing cycle fee. So now you're paying $204 a month and your principal's only going down by $30. So if you do the math, it's going to take you a little over 4 years to pay that back, and you're going to pay back $10,770 in the end. Now, this is compounded by the fact that, as I said, many households that we see have more than one. Next slide, please, India. So, as a result of seeing so many families struggling with this problem, and typically it was when an unexpected expense arose, their first go-to was a high interest lender. Now, they don't always call them loans, they call them personal lines of credit, among other things. But at the end of the day, the amount of money that these families are expected to pay for the little bit of money that they take out, it's almost insurmountable. So we got the idea to develop our own lending program. And we're calling it Dollars and Cents. But the purpose of the program is to provide 0% interest small dollar loans up to $1,000 to clients that are working with the Financial Opportunity Center to address any need, as long as it's a need. They will meet with us monthly as they go through the repayment program, and we're also, in true Habitat fashion, integrating a component for volunteerism, or sweat equity as Habitat for Humanity calls it. So following 3 months of on-time payments, participants will be able to volunteer in lieu of making 1 month worth of payments. We did a lot of research working with a number of organizations that have been doing this type of work for over 100 years. And they found that for $1,000 loan, a 10-month repayment period is about as long as you want to go. And by focusing on $25 ACH deductions every week, they can afford those payments without it being a huge burden on their already tight budget. But again, 0% interest and no fees. We have to build out the criteria to make sure that we're not just handing money out to people who are never going to repay it. So as we're looking to evaluate an application, we look at, is it a need or a want? If they need a car repair to stay employed, that's a need. If they want the latest and greatest Michael Kors purse, that's not a need. We're looking at the fact that this small dollar loan has to address the entirety of the situation. If they're $5,000 behind on their mortgage, a $1,000 loan isn't going to help them. It has to put them in a better financial position. So again, if you're behind on your mortgage by $5,000, that $1,000 isn't going to help, and it's not going to put you in a better financial position. They also have to have the ability to repay the loan, again, at that $25 per week over the 10-month time frame. Now, if they borrow less, then their time frame will adjust accordingly. We have many families that also need critical home repairs. So Habitat provides those repairs. So we're also looking at how can we support these families who need these repairs to stay in their homes using the same model. Ironically, this was something that came up. Our local community foundation had reached out to us and said, we heard about what you guys do. We have an anonymous donor who wanted to know what's something you've always wanted to do but never had the money to do it. And I opened my mouth and said, well, of course, micro lending at 0% interest. And we received a check not long after, and we're told, let's see what you can do with it. So initially, this is a pilot program for existing Financial Opportunity Center clients. And depending on how this goes, our plan would be then to continue to cultivate funding and open it up to the community as a whole.
Dustin, that was really helpful and like a really great perspective on the individual, like a really great program to start for an individual client to like how they can address and learn and you know, work with coaches to resist or find options if resisting isn't an option, you know, paired with the FOC model, but also like, you know, I feel like your dollars and cents could be modified for others. And I love also your great example of like what happens when you amplify your story in the community. You know, like here comes an incredible private anonymous or confidential donor, which could be a really like a boon for this kind of program. But perfect, Dustin. And we'll have options if you want to drop questions in the chat. You can. India will put Dustin's contact information if you have more questions for him as well. I do want to hold your questions till the end, but we will get hopefully an opportunity to ask. But in the meantime, I do want to transition from the individual to the community level and have Valerie Moffitt share. And Valerie has 2 decades of experience working in government and nonprofit organizations. And of course, she works for LISC, but like, why wouldn't I use a resource that works in our world? And she started at the LISC Toledo office, and it is a coincidence. So we have a lot of Ohio representation, but it just happens that way. But she started at LISC Toledo and she focused on starting her own, starting and growing their financial opportunity center. And as part of that work, she also worked on a lot of quality of life policy and initiatives to improve the life of Toledo's core city neighborhoods, including on the local level, leading a moratorium on predatory payday loan lenders opening in the city, and worked with statewide coalitions to effect payday lending reform in the state of Ohio. So Valerie joined the National Income and Wealth Building team in June 2022 and continues to advocate for equitable access to safe and affordable financial products and workforce opportunities. And if you have not had the opportunity to tuck into a corner and chat about the world's ills with Valerie, I highly encourage it. It's one of those, always one of those conversations where you feel like you've probably just solved everything if you could just remember everything you just talked about. But with that, Valerie, I'd love to share a little bit more from your perspective on like a community-based level and, you know, what we can be learned from there.
Thank you, Julia. We can go to the next slide, India. We're going to skip this title slide just a second. I just wanted to show that was actually from our community, and we'll get to what that was about a little bit later on in the presentation. But I was thinking about telling the story of how the Toledo community residents and grassroots organizations came together to impact and effectively stop payday lenders from coming into Toledo and requiring a closure of a certain number of them actually over the long term. I started thinking back to the other type of health and safety and justice and community condition actions that I had the honor of working with the residents on as I served my tenure, not just at LISC Toledo, but previously for a local community development corporation. And so I thought, rather than just hear me yammer about a story and tell a story, let me provide you with a framework. So I started thinking about the similarities. What we're about to go over, you can apply for any issue or need that your community has that we're getting ready that needs to be addressed. And since I love acronyms, and you know, long-term policy and system change is a dance, our acronym that we're going to follow today is Roomba. Okay, so you can go to the next slide and we'll just jump right into it. So when we're talking about recognizing an issue, and I choose recognize rather than identify, because identify sounds like you're sitting in a room somewhere and something's really irking you and you decide this is what needs to happen. That's not really the case. Change is always driven by and led by community need, not one individual's opinion of what is needed or what should be needed. It's actually, what is my community telling me? And so for the recognize, all you have to do is look and listen. Use your eyes and your ears. Your community is telling you every day what the emerging needs and issues are that need to be addressed. And those, you can recognize these in a variety of ways, either anecdotally or through your physical environment. And so how this came to light, this whole piece around the short-term lending ordinance in Toledo that effectively stopped the proliferation of predatory lenders coming into our community in physical locations. It came through our financial coaches and the work that our FRCs were doing. Just like Dustin explained, the need for the products that they have developed are coming from responses to what coaches are hearing, what clients are telling them. And what our coaches and clients were telling us was that their clients with subprime credit scores, which is most of our clients when they enter financial coaching, they were caught in the churn of a predatory payday loan or have lost their car to a predatory auto title loan because they were taking out loans on loans on loans to meet loans. And then that also stacks up those hidden fees that you're not paying attention to. But also, this is more of actual data, but not rather than an anecdote. But what we started then learning from our coaches was, well, what is the data telling us that we have? And as part of it being an FOC network and a financial coach involved, even though your clients aren't buried in paperwork, you as a coach are buried in an online data system tracking progress and metrics over time. And what we saw was there was an increase, an overwhelming, not just the credit not moving for the clients, but there was an overwhelming increase in the number of clients who were accessing payday loans in the community. So we knew we needed to do multiple things to solve this. And we did it on multiple levels. We started at multiple levels, but we ended with this large legislation piece that we'll be talking about. So that's one way to recognize what's happening. The other way to recognize what's happening is just open your eyes. Oh man, this is a picture of an actual, no longer here, title. We saw it, we were used to the, cash a check here, get your payday loan, get it now, get paid early. But this was happening in 2016 around the time that suddenly auto title lending and payday lending were synonymous. And on every other corner, there was an auto title loan place, which it's similar to a payday loan, short-term repayment terms over a very restricted period of time, high payments, high interest. You used your car as collateral. So it's not a matter of just missing and getting a fee. It's missing payments and losing your car, which is your livelihood, usually attached to how you get your children to school, how you get yourself to work, how you get access to basic needs. Because let's face it, in Toledo, Ohio, we are car country. This is the Midwest. You can't live without a car. Public transportation is not the greatest in Northwest Ohio. Don't tell Tarda I said that. But anyway, but what we were seeing is this was happening. And I would get so frustrated, having heard from the coaches or even met with clients, who were giving testimonials and interviewing clients. I was seeing these everywhere in the communities where I worked and where I was living at the time, because I was living in my service area. So it was very frustrating to me. At the same time, you're also seeing an increase in mailings and spam emails and now digital ads everywhere, promoting the high interest payday loans. So it's hard to recognize, it's hard not to recognize what's right in your face. If you move to the next slide. So after you've recognized it, after you've understood, seen, looked, observed the emerging needs in your community, the next thing you need to do is to really understand that emerging need. And that emerging need can be well understood through research, through really understanding what communities have experienced, what other communities who've experienced this issue have gone through. How is it different or the same in your community, and what's really happening in other communities that might be applied or tweaked to be applied in your specific case. So in order to strengthen your understanding of the issue, one of my favorite things to do is research and analysis. And when I say research, don't feel like you have to go to a library and be like bogged down in books. Type something in a Google bar, and I'm telling you, AI and research, oh my goodness, I'm in love. So anyway, but also be careful, like vet your sources once you do the resource, keep digging. But in this initial stage of research, and I've listed a couple of places, several places you can look to, think tank reports like Pew, huge think tank, very involved in this area. But I ran across one particular article from the Consumer Federation of America that published a piece on the very thing that we were experiencing, but it provided examples of how communities across the nation have enacted legislation to control the growth of predatory lending in their communities. And I thought, let me look at this a little bit more, and let's just really dig deep and see, is this something that's possible here in our community? And turns out it was. So then our next step was to, next slide, mobilize. So this is where you really start digging in. And now that you've recognized and understood the issue at hand, you start to gather your resources. And you guys have probably heard of SMEs before. Those are your subject matter experts. So start asking yourself, who are your subject matter experts and what resources do we have available to us in our community? One of the most valuable resources, actually, I think the most valuable resource that you have for any endeavor that you do is human capital. It's the people. And when we're talking about your subject matter experts, I'm not just talking about these incredible, brilliant professionals like Dustin and Gabe, who you see on the screen right now, but I'm also talking about the individuals in your community, your residents who are living the experience right now. They're one of the most valuable subject matter experts you have to really help you move things forward. And so when we started looking around, we had our subject matter experts, we had coaches, we had individuals, we had connections with these other agencies, these other think tanks to help us understand things deeply. And so we felt like we were pretty solid, and we had tons of residents with lived experience, these clients of our FOCs willing to stand up and say, I've had enough, I'm going to show up and I'm going to help with this. What do we do next? So gathered all of the people, we started looking at funding. Like, there's not a whole lot of funding available for community organizing or community-led efforts, as most of you guys working for CBOs understand, but there is funding available if you dig. And where we dug is we looked at our local, since this was a very hyper-local issue, we were looking at hyper-local funders and seeing who had priorities that aligned with addressing issues around financial inclusion. And we went to United Way, and we didn't expect a lot of money. They make their allocations, but I'm telling you, if you dig, your local United Way is a great place to dig and see. I know your community impact committee has set aside just a tiny little pot of funds for innovations. Here's an innovation, here's what we need. What we were able to get from them was $15,000 grant that then we were able to leverage into in-kind resources, such as $15,000 paid for a full-time AmeriCorps member to kick off the research, the mapping of our community, if you will, because we knew it, we just needed to prove it. So we were able to engage an AmeriCorps member to help us. And one of our professional subject matter experts that joined us early on was from our local Advocates for Basic Legal Equality. And he's like, I can give us an intern to help. So once we get the mapping done, we can do a full-on report. And then from there, we can take this and move to our next step, which is actually looking at who do we have as our champion in the legislation? That's okay. Yeah, you're right. Go ahead. We're there. So after we mobilized, the next thing we did is we started to build. We expanded our base. We brainstormed we'd already determined our strategy. We had everything in issues. We had aligned resources. We needed more people at the table. So we got the more people at the table. We met with local council leaders, local council members. We met with Plan Commission members. We met with City of Toledo Law Department. We met with everyone that we could meet with that controlled the regulations and ordinances governing our city to see, does anyone want to take a bite here? And we had unusually, most people were like, oh, there's other issues facing the city. Nobody, this is anti-business. Nobody wants to do this. This is anti-business. We don't want to shut businesses down. And I'm like, they're not bringing revenue. They're jobs. No, they're not. Like, I'm like, and they're not good jobs. Like, do you want just a job or do you want a good job? So many issues, but we did find our advocate. We found our champion, and Dr. Cecilia Adams, who at the time was serving on our Toledo City Council. And she's like, I'm fed up with this too. I hear this too. I have personal experience with this. My family member, my friends, you're talking about people I know and love and care about who are affected by this. So she stepped up. And so we started to connect those resources, and with her and everyone else we had around the table and new people we were joining in. For example, as we were wrapping up pretty close to the end of submitting our legislation for consideration, the Pew Charitable Trust had partnered with statewide legislators in Ohio to really hone in on governing those percentage rates or quote unquote hidden fees. You'll see here at the time in Ohio, the interest rate on a payday loan was close to 600% before we were able at a statewide to address that. We were stuck at a local level because local ordinances, because of something called home rule, we couldn't have the city of Toledo pass an ordinance that restricted the percentage, the APRs on these payday loans, or restricted the fees on these payday loans, because it wasn't in our purview. That is at the behest of the state legislature. That's not something local municipalities and communities can control in Ohio. But what we could control was zoning. And so what we could do is we could work on zoning, and working together, our strategy was that we built consensus around was we're going to introduce a zoning legislation that basically limits how many payday lenders can be within so many feet of each other, which that limited how many could be in a community. And similar, I believe, to what Dustin had mentioned in the beginning when he was talking about what they're realizing in their community, is these storefronts, these physical storefronts, were locating, and we'd done the mapping and we compared it to national research and showed that just like the national research shows in Toledo, these types of institutions, these predatory payday lenders and auto title loan lenders, were located in communities of color and low income communities. You wouldn't go to the more affluent and the more homogenous a neighborhood got in terms of being white. You were not going to see these types of lenders there. So what we were showing is this is part of the predatory nature. And so we ended up saying you can't have so many within so many feet of each other, which meant that that in and of itself meant that no new predatory lenders would come to Toledo. On top of that, we limited and put a cap on the number of these types of businesses that would be allowed to exist in the city of Toledo on a per capita basis. At the time that we did this, there were close to like 50 or 60. And based on the per capita calculations, it was reduced to 30. Toledo could have no more than 30. Of course, they couldn't affect the ones that already existed because of the fact that they were already protected and grandfathered in by law. And what we found out from, I'm probably getting ahead of myself. Let's go into the next one. So we've connected our resources, we've defined our strategy. So you can go to the next slide. This is where we're acting. This is what we're doing. This is where we're implementing our strategies, and then we're amplifying the success and or the challenges afterwards to make sure everyone's aware. So when we're implementing this and we're walking through drafting the legislation, getting everything together, anticipating our opposition, because of the fact that this was happening at a time when there was also a statewide push to limit the percentage for the APR and the fees related to payday lending across the state, there was a lot of opposition. There was huge trade organizations, lobbyists. They were coming to Toledo to meet with us to attack our tiny zoning ordinance because it was anti-business and people need this service. We're the only game in town. What we had done, having gone through this framework previously, we were like, yeah, you're not the only game in town. There are several games in town. And that gave us a chance to amplify our financial opportunity centers. It gave us a chance to amplify our credit builder loans, match credit builder loans, and our employer sponsored small dollar loans. So we had already implemented more reasonable solutions to payday lending in Toledo by the time we got to this point when we're advocating for this legislation that, again, effectively reduce the number of these types of businesses in our city by putting a cap on it. So at least 30 would have to close before one more came in. And if one more comes in, you can't go in this community because you're already too close to another one that exists in the community. And the beautiful part of it is when this was piled on and added to the work that was accomplished at the statewide level and getting through the interest and fee reform that was needed, these businesses shut down. We don't have a single auto title lender storefront in Toledo. We just don't, because they can't physically operate anymore here. The framework, it doesn't work for them anymore. It's not a welcoming environment. So the whole point about this is you can go through these steps, run through what it looks like for you and how you can apply this in your community. There are tons of examples of the work that we've done. You just have to search and dig for them. And there are great additional national resources like Gabe and his team and others out there who can help guide you and support you along this journey as well. I'm going to stop talking now because I probably talked over my time, and I'm going to give Gabe a shot, and then we can come back for any questions that you have on anything.
Well, thank you, Valerie. It's really important to, we are running behind, but I feel like we started this way. So, but it's really important to see the community action that can be done. And for a lot of our participants here today, like they are nonprofits coming from a different perspective, and it's good to have like a little action plan to how that make that work. And you did call out Gabe a few times, so thank you very much for helping me transition to Gabe. And Gabe is a manager with Pew's Family Economic Security Portfolio and Housing Policy Initiative, providing research and analysis to policymakers, regulators, and other stakeholders at the state level on consumer and home financing issues. He has helped secure policy change that are saving consumers billions of dollars, big B, annually. But before coming to Pew, he also worked as a community organizer in Minnesota. So we obviously have a lot of northern representation here. But Gabe, of course, you'll be able to give us a much more a much wider perspective on what this is, and that's some other of the alternatives that are out there and what the research is showing. So Gabe, I will turn it over to you.
Okay, thanks everybody. I'm really happy to be here and hearing all the great stories and inspiring examples of community change. My name is Gabe Kravitz. I work at the Pew Charitable Trusts. Pew is a large nonprofit. I'm based in Washington, D.C. And I work with state policymakers and advocates and regulators all across the country to improve financial well-being for families across the U.S. Pew, more than a decade ago, set out to understand what was happening with payday loans, to understand who the borrowers were, what their experiences were, what they wanted to see improved. So we fielded the first ever, I think only ever, a nationally representative survey of payday loan borrowers. We conducted dozens of focus groups with consumers across the country. And if you go to the next slide, you can see some of the kind of key demographics and kind of who's borrowing payday loans. But it's 12 million Americans are taking out payday loans each year. All payday loan borrowers have something in common. Every payday loan borrower has a checking account, but that's what's used as collateral for the payday loan, and they're leaving the safety of their bank to go borrow at much higher rates from storefronts or online. And on the next slide, you'll see, so the kind of the core harm that we've learned from our research is that the payments are unaffordable. The loans are due back in an unrealistically short amount of time, just 2 weeks typically, and it takes up a third of a customer's paycheck, of the borrower's paycheck, and it's not realistic or reasonable to have someone sacrifice a third of their paycheck when they're trying to make ends meet, pay for groceries, rent, or a mortgage payment. And so what happens is, as we've heard from Dennis and Valerie, is that people end up, instead of paying it all back at once, they go back and they just pay the interest-only fee repeatedly. And the typical borrower signs up for a 2-week loan, but is in debt for about half the year, 5 months of the year on average. And they end up paying far more in fees than they receive in credit. So just as an example, in Texas, if you borrow $500 for 4 months, you're paying $645 just in fees alone. to borrow that amount of money. So that's a $1,145 total repayment. We know that these prices are also unnecessarily high because we've looked at what all the largest national lenders charge across the country. These are the same companies operating in different states, but they have to follow different rules. And so we know that in a place like Texas, they're charging much, much more, you see. So I said 645. After reforms in Ohio, they're only allowed to charge $159. So we're seeing, lenders charge 4 or 5 times more in a state that they're allowed to, just because that's what the state legislature allowed. So on the next slide, we'll just walk through kind of why this is and what's happening between the borrower and the lender. When a person's in financial distress, they're focusing rather than on what's affordable and what the price is, they're focusing on things like speed and convenience and how certain they are to be approved for the loan. They need the money quickly. But what affects their financial health is how can they afford it and what the price is. And so that's a market failure where that financial distress of the borrower leads to a lack of price competition. The lenders know that the borrower is not focused on what the price of the loan is. Instead, they're focused on ease and certainty of approval. So what they do is they set up storefronts closer and closer to consumers. And those storefronts serve fewer and fewer customers. So it's a very inefficient business model, all based on that dynamic. And so on the next slide, you'll see, as kind of Valerie described, that really major reforms that happened in 2018 in Ohio. You can give a picture of what it was before and after here. And the story of this reform coming into place was really inspiring. It was bipartisan. There were faith leaders, business leaders, local organizations, racial justice groups, rural advocates across Appalachia. A really kind of amazing coalition came together to get it done. It was sponsored by a legislator named Kyle Kaler from Springfield, Ohio, and Mike Ashford from Toledo. So he was, I think, inspired by a lot of the work that Valerie described to participate and really champion state legislation to reform the market. And as Valerie mentioned, one of the main pushbacks that we got from the many pro payday proponents at the legislature, both their lobbyists and lawmakers, was that, well, where are people going to go when these regulations eliminate access to credit? But what we knew from beforehand was that other states had already implemented similar reforms, and the lenders were able to still make credit available. And lo and behold, that's what happened after reform. There's data reporting in the law, and so we're seeing that credit is still widely available, and customers are saving more than $75 million each year. So in aggregate, it's been $300 million of savings over the 5 years of the law being in effect. So on the next slide, I'm going to skip actually down one more. Thanks, India. And so what we also know is that, like I said, every payday loan borrower has a checking account. And one of the reasons, clearly the clear solution for much of our research has pointed to, well, we need to be able to get better credit from banks. And we're finally making some real headway on that in the last few years. And what we learned from lots of extensive research with banks and credit unions is that we know that depository institutions have a lot of advantages, and they can actually offer small loans to these customers for a fraction of the price. So we've modeled it out, and we've worked with banks as they're designing products, and we know that they can charge about 15 times less than a payday loan. And so on the next slide, you'll see that the good news is, after many years of federal policy and regulatory work, we finally got into the place where 6 of the 8 largest banks in the United States started offering affordable small loans. And on the next slide, you can see what those look like. and they're due back in 3 or 4 months. They have small payments that borrowers can afford. And unlike a payday loan, you're paying down the debt and able to get out of the loan as advertised, which is the goal. They're still, higher cost than a credit card, but 10, 15 times cheaper than a payday loan, which is pretty amazing. We're seeing these begin to scale. Bank of America announced that they've done more than 1.6 million of these loans since launching their product. Wells Fargo announced last year that they'd issued 500,000 loans just in the first year of their product being rolled out. And we're also seeing at credit unions that credit unions are stepping up and offering more and more small payday alternative loans, and they've hit record numbers in their of credit union alternative payday loans over the last 10 straight quarters. So there's real growth happening in the kind of alternatives from financial institutions. I'm going to skip the rest of this and just down to a finding that's on my slide 18, and I'm not sure if you're able to grab that, but so as you are thinking about how do we make this work for consumers, and how can we encourage more and more banks and credit unions to get in the market, they can really be a part of the solution. We're seeing that already. Right now, banks that represent about a quarter of bank branches across the US have a product available. But that means that there's a lot that still need to get in the market. And so one action item coming from today is that if you work with banks and credit unions in your community, this is something that we hope to see scale really across the whole market. This should be a standard product from a bank or a credit union. And to make these work, banks and credit unions need to focus on the things that payday loan borrowers are otherwise looking for, which are speed, ease of convenience. These funds have to be available really quickly. And then we know that because of how they're structured, these products inside banks are much more affordable. They're priced well, and they've got standard safeguards and regulations just by nature of being in the banking system. So there's some good news, and we're actually doing additional research now with some of our partners who are talking to payday loan borrowers or former payday loan borrowers or people who are now currently using these bank small dollar loans, who had previously borrowed from other high cost lenders in the past. And the results are really, really promising. People really appreciate having access to their to credit from their bank directly. It helps with their satisfaction about having banking with that bank. And yeah, people are saving hundreds of dollars as a result on the individual level. So with that, I'll wrap it up, and I'll hand it back to Julianne to close this out.
Wow, we just had an overabundance of information to share. So I am not gonna, we don't have any extra time for questions, but I do encourage you to drop them in the chat, and Gabe and Valerie and Dustin will respond to you. I will send them, I know your emails because we know how to track you down. And I'll make sure you have the answers to them. But I do appreciate Dustin, Valerie, and Gabe. Thank you so much for your time. This was an extraordinary amount of information, but I also really appreciated how you provided entry points no matter how people are coming at this issue. And I'm sure we'll be continuing this conversation as more facets of this predatory lending become more obvious. Again, if you have questions or comments or chats that you would like to direct to Dustin, Valerie, or Gabe, or even to India and I on how you would like to hear more about this topic, please drop it in the chat or send us an email. But thank you so much. This was incredible. I really appreciate Dustin, Valerie, and Gabe for your time, and everyone who was able to participate today. This is recorded. We'll be posting it online and sharing it afterwards, as well as the PowerPoints, which is really helpful. And thank you so much. And if you haven't noticed, Gabe has dropped a really interesting chat link to a calculator to see how your state protects payday loan borrowers. So really helpful. But thank you all so much. There are a couple questions in the chat. I will not forget them. I will see them. I see 2 questions specifically.
I wonder if we can like there's one question I think for like the last minute would kind of be a good kind of closing point if we have the time. As a financial and employment coach, what are the most effective ways to educate our participants or communities at large about fair credit and avoiding predatory loans? If y'all have any insight, I know that's a big question, but I think it would be helpful for a lot of the folks on this call is before we leave. Any parting thoughts?
I can tell you that about 70% of all the referrals that we see through the Financial Opportunity Center are word of mouth. So get the conversation started. We do a lot at the individual level, and they're going to tell their friends and so on. But never underestimate the importance of finding that one person who really connects and understands, and they're going to go out and do your job for you. So we do a lot with individuals, and we give them something to talk about.
And I would just add to that, use your local media resources. Like even if it's a small publication, small paper, see if you can get an op-ed, something in there talking about this. It'll get it more broadly to the people in your community. I know print news is dead, but you can also do it online, do blog posts, anything that you can do and relate and refer back. And I don't know, start a TikTok channel. I really want someone to start a TikTok channel on fair credit. Can you do that? That would be wonderful. And then like, let me know what your handle is and I'll follow you.
Gabe, do you have anything you want to add to that too? Awesome. Well, thank you so much. Thank you, India, for popping in that one question. It was important. We will also clip that answer so that if you are not interested in watching the whole video again, but you want to hear just what Dustin and Valerie said, we'll clip it out. But I apologize for the confusion. I didn't realize that chat wasn't available for some of you, but I'm glad you found question and answer. Good job, guys. We will release you. Happy rest of January. And look out for future webinars, as well as sharing the video from this webinar. But thank you all so much.
Thank you, guys.
Thank you, India. Appreciate it.
Thank you, Gabe.
Oh, sorry, I'm muted. Thank you, Gabe. We appreciate it. This is really great.
We'll be in touch
Very...
for sure about other things we want to talk about.
Sounds great. Looking forward to the next time we chat.
Absolutely. Thank you.